So who would you say is the number one liquidity provider in Nigeria?
One liquidity.
One liquidity, of course.
I believe one liquidity is going to get there someday.
I must say, like, their services are good and sweet.
Let me leave that to the users to judge.
Hey, I'm gonna say one liquidity, right? So we go from there.
One Liquidity isn't just talking innovation. We are walking the walk with impressive figures that showcase impact on Africa's financial landscape. Here are some key numbers that speak volumes. $5 billion plus dollars in transaction, $10 million plus dollars in monthly credits and loans, $500 million plus in B2B payments. These numbers translate to real progress. Businesses have access to the resources they need. Trade flourishes and Africa's economic engine gains momentum. One Liquidity impressive numbers are just the beginning. By choosing One Liquidity, you are not just partnering with a financial service provider, you are joining a movement driving positive change across Africa. Sign up for a demo account today.
Hello guys, welcome back to another episode of FinTech Insights with One Liquidity. We're very excited to be having another section in the month of October. We're very excited, and the topic for today's webinar is very exciting. It's a topic that I hold very close to my heart. It's interesting, and we're very confident that this is something everyone is going to learn something from, especially people who are building their company and don't exactly know how to give quality shares, be able to share a fair amount of ownership to the people on the team. So today we have a very exciting topic, and the title of today's topic is From Idea to Exit: How to Structure Equity Properly. And we're very excited today because we were able to partner with GetRaise to host GetRaise to come onto this webinar and talk about what they do and give us more insights on today's topic. And we're very privileged to have Mr. Marvin on today's webinar. Marvin is the CEO of GetRaise, and we're very excited to have Marvin join us today. Hello, Marvin. How are you doing today?
I'm good. Thanks for having me.
I'm very excited. Welcome, Marvin. How's the weather over there?
All good, my friend. Thanks for asking. Hope as well with you too.
Yes, all good on my end as well. So we have a culture to always ask an interesting question to kick off, an icebreaker question. So the question we have for you today is, what is your favorite movie of all time?
That's easy. That's Interstellar. The space
Interstellar.
movie, Christopher Nolan.
Uh-huh.
Yeah, best
That's
movie
a
ever
very
made.
that's a very good one. That's a very good one. All right, that is
Yeah, good
cool. So
question.
Marvin, yeah, very quickly, tell us a bit about yourself. Something interesting that we should know about you, what you're working on, what you guys are building at GetTrace.
Sure, yeah, it's just Raise, not Get Raise. We changed that domain name, and
Okay.
we build software that helps African startups manage their equity, corporate structures, and legal operations. And we work with quite a few companies in the ecosystem, and the goal is to build out standards and structures for companies to go from idea to exit. So this title is very relevant. You can find Raise at raise.africa online on our webpage. You still with me? Doesn't look like you
Yes,
in the
I
call.
am. I
Okay,
am.
yeah, sorry. Stream Studio is a bit funny. So yeah, that's what we do. That's what we build out. So companies who come to Raise, you could get your corporate structures optimized and built for a specific kind of industry, licensing, etc. Ownership, which is structuring your equity for your team or investors, or calculating what the equity could be worth over time and valuing what a business looks like. So we provide all of those services and products in one place.
Well, that's very exciting. I think this is something that companies in the US take very seriously. You talk about companies in Silicon Valley, in New York, they take this very seriously. But in Africa, we hear issues where people are always feeling like they were cheated out. And I think that it's very interesting what you guys are building at this point in time in Africa, because as we attract more expansion, this is a very exciting part of product or building that we need to implement. So that's good.
hmm I actually glad that you said that and started off that way.
Hmm.
And the reason I say that is because I could tell you after 6 years of selling equity software across the African VC ecosystem, any country, any accelerator, any venture firm, any CEO you can think of, we've spoken to. And I could tell you as well, I've worked with Carta and AngelList and Republic and all of the other versions in the States and in Asia. And I could tell you for a fact that the African ecosystem across the world is the ecosystem that takes equity structuring and corporate structuring the least seriously. And that's a big problem. Everybody
Yeah,
just kind of wings it and hopes for the best.
it is. It is, and then I think it also leads to it causes a lot of disappointment, and then when at the time it makes it difficult for valuation, for buyouts, when big corporations tend to come in and they want to look at what you guys are doing, do their due diligence on you, everything just looks like a mess. And I think it's very interesting that everybody who is reading stuff needs to talk to Grace and make sure that they have like all the structures early on. And we're very excited about everything we're going to learn from you today.
Hmm.
So our first
That's
question
right.
for you today is, what does equity mean in the context of startups and why is it important?
Yeah. So equity is the most fundamental asset any startup has. And the reason that is, especially where we are, is that everything we're building is software and intellectual property most times, right? So 1L is built on software, and your clients and customers interact with that software to swap different cryptocurrencies and cash. But at one point, it was just an idea in Monachi's head. And
Mhm.
so eventually, that intellectual property became a software. And then, the team that y'all have built the whole sales process around it, and you started selling customers on it. It started generating revenue. That became a business, and that equity suddenly had value. But before, when it was just in someone's head, it had no value, which means it wasn't worth anything. And so it's the most fundamental asset any startup, especially technology based venture backed company, is going to have. It determines how you raise money, it determines how the employees get ownership in the company, it determines, like you said really well, how you're going to get bought out. If you're going to get bought out, how the company is going to grow, how you're going to exit. It determines everything. But the reason I think it's not taken seriously in our ecosystem enough is that you don't have to really worry about equity on a daily basis. You don't have to worry about it when you're shipping your product roadmap. You don't have to worry about it when you're on a sales call. Like, it's not really something that you're thinking about. It's kind of like your server, in the same way that you're on a sales call or a product call, and you have things that are going on that call. You're not really thinking about the servers that are maintaining liquidity. It's the same thing. if the servers went down, then the business wouldn't exist. And it's the same thing for equity. If the equity ain't structured, the business is poorly structured, even if it looks good on the outside. And so, at least, from working with 2,000 plus startups in this ecosystem, the ones that take equity seriously and structure their stuff very intentionally at the beginning are typically second time founders, or just founders that are just experienced at what they do, such that they will structure it very intentionally because they've learned from mistakes, and they pay for it because it's valuable. The ones that don't, pretty apparent, risk it, get burned, and then some of the issues, like you said, we've had in our ecosystem as a result of us not structuring equity really well. So, teams will invest in their servers before they invest in equity until the day they have to. And then, by that time, the equity is so badly structured and disorganized that people lost money, people lost value. Legal firms make a lot of money fixing things up. And, this all could have been avoided. And so that's the other thing about equity. It's very important for a venture-backed, software-based business anywhere in the world, but especially on the region we build in on the African continent.
All right, that's very beautiful. I have to ask, right? So you are the forefront of solving this problem in Africa, right? And I think from where you've been, you just mentioned you've worked with over 2,000 startups, and off the top of your simply from your experience, you can tell that yes, it's easy to sell raise what raise does to second time founders. Most times you don't even have to sell them; they come to you and they're always asking. They're asking the right questions. They know what they need, right? I know people who just want to get their app running or get their product MVP out, get a seed fund, get a Series A, whatever the investor says. Yes, we give the investor 10%, 5%. Let's just get our product out and start running.
Yeah.
And you're like, no, look, guys, what is your ownership structure? Like, no, we'll figure that out later. We know the African culture where we want to jump first and figure things later. I think the question is, can you hear me?
Yeah, I can hear you clearly.
Right. So the question is, what do you think is wrong with Africa regards, being aware of the of equity early on? What do you think is a challenge?
It's a good question, man. I think first thing is, a pre-seed company shouldn't really spend too much time on this stuff. They should just structure it and keep moving on, like you said. Seed stage companies plus really have to think about this stuff a lot. So anyone on the call, hopefully that helps. Depending on your stage, you should spend a bit of time on pre-seed and not look at it again. Seed, this is top of mind probably every quarter of the year. And then wrong, I don't know if anything wrong with it, Michael, is more just like, how do I say this? I don't think there's any wrong with this ecosystem. It's just a new asset class, right? Startups only started getting funded in Africa, like really in 2019, right? So we only had a generation of learnings, if that. And so I think it's more just understanding what's important. If you look at private businesses in Africa's capital markets in general, they take this stuff very, very seriously. They pay law firms a lot of money to structure this stuff from the very beginning of the business. They don't play around. Whereas with startups, I think, when there's a promise that you could raise $400,000 with 2 customers on your pre-seed MVP, then obviously you're just going to do that, and there's not going to be any fundamentals behind that. That's obviously changing now, but the first generation of startups we had in Africa from 2019 to 2022 had access to really easy capital, myself included. And we didn't realize it at the time because it was the first time we were doing it. And so we wasn't able to really learn in an environment that was hard to learn in. And now we're definitely learning in this environment now. And so we've definitely had a lot more companies come true lately in the last, since 2023 to now, because the market shifted, right? You couldn't go out and raise 400,000 on a pre-seed with 2 customers. You really had to show value and build out. And then the VC market is changing across the world because the cost of technology production is going down significantly, right? What costs $10 million to build in 1999 takes $500,000 now, but what cost $500,000 to build the software in 2020 probably costs like 100,000 now, and that trend is going to continue. And so going out to raise 10 million back in the day, and then going out to raise 500K in 2020 to build that out, that isn't necessary anymore. The best founders notice, and the best founders are positioning themselves to bootstrap their businesses and build in such a way that they don't need to depend on external financing. They just build from the ground up and build it really well. Your company is one of them. And the other one's just going to kind of figure it out. So I don't think there's anything wrong. It's just learning the patterns of what we've had to face as such that we didn't have to learn hard lessons. And like you said, we know our people. When money easy, things easy, and life just goes on. And so we grabbed a bunch of easy money and hope for the best, and this not the right environment to do that. That makes sense?
Yeah, it does. I think that's beautiful. I think it makes sense because to be fair to Africa, we it just kicked off. We're just about second generation of building out, and I think we're on a great trajectory, and it's good. I also have to say this. I think that what you're doing at Gettys might not get the recognition it needs now, but I believe that like in next 10, 20 years, people are going to look and say, oh my God, all the amazing work Marvin has done is paying out. Just like Inyi, Oluwa Abuyechi, all the work he's done in the past decade with starting off his coming to build in Africa, Flutterwave, and where he is now. We're all enjoying it now. I think that's amazing. So look forward to hearing all the amazing work that you would have, all the structures you would have put in Africa in the next 10, 20 years.
Yeah, we'll see. I don't really care for it, but hopefully because that would mean the ecosystem is valuing fundamental things. I think a lot of people don't realize that Ian doesn't care what people think about him, and that's okay. He's a good friend of mine. And we live in cultures, and we all come from cultures where everybody cares about what other people say. So when someone comes along and doesn't care, it's like, whoa, who do you think you are? But then you look back and you see the fundamental structures that have been built. Like I remember one time Ian was talking about how important venture debt was for the ecosystem. It took Silicon Valley many years, decades, to get to the point where they appreciated debt financing. They always did equity. And Ian was talking about debt, and I think maybe like 2 months later they launched like a huge debt fund. And so it's like when people look back at all these different structures that were built for this first generation, hopefully, yes, they appreciate the collective work that all of us would have done. I think it'll probably be forgotten by then. But all of these different pieces and components went into building the first kind of, like you said, generation of companies, whether it was Paystack exit or like this company being built or the first like crypto and stablecoin rails that 1L would have built. Like all of this infrastructure was part of the first generation. Yes. Hopefully the second generation don't mess it up. They got one job to go from idea to exit.
Exactly. That's beautiful. All right. So our next question for you is how should founders think about equity distribution at the initial stages of their startup?
Yeah, for sure. So there's a couple different stages, right? There's that stage where we're going to call you have an idea for something, right? And you have a feeling it might work, but you work in a full-time job, right? You didn't really want to take that step first. Everyone's going to spend a lot of time opening up a financial model and seeing how much money they can make, which is cool. That's probably a really good step. If the business ain't going to make money, then don't do it. The second step right after that, and probably in a tab next to that financial model sheet, should be a cap table, right? If I own X amount of the company and my team owns Y percent of this company, and this financial model is correct and we get to this much revenue, then what does this business kind of look like over time? Not necessarily as an exit, which is really intimidating to model out, right? But more as a profitable business. And so that shift that I talk about has happened now is Silicon Valley champion for decades this idea that you build a company from idea, right? You get it to seed stage, right? At that seed stage, you have, 20, 30 investors on the cap table, about 40, 50 employees that own ownership in the company. And then the dream is that that company gets sold or goes to IPO, et cetera, et cetera. That ain't the case anymore. I don't think it ever was the case in the African ecosystem. No one should be fooled by all these mergers and acquisitions happening for African companies. Very few of them actually exchange cash. The vast majority of them exchange equity. So I want to buy Michael's company. I give Michael 1 share of my company in exchange for 2 shares of his company. I'm not giving Michael $10 for 2 shares of his company. And so we have to be really careful and realize that most M&As in our ecosystem operate that way. How M&As are supposed to work is I want to buy your company, Michael, and I give you $10 for 2 shares of your company, not $2 or 1 share. And so, yeah, the idea of exiting is changing. Exit today, and probably has always been the case in Africa, is profitability. And when you model out that financial model as an idea-based stage or a pre-seed, seed stage, all you got to do is figure out what the cap table is meant to look like. Investors going to take you more seriously. You're probably going to take yourself more seriously. You're going to put in the fundamental like infrastructure in place to ensure that this stuff never gets messed up. And all of us make mistakes, myself included, in doing this process. After the pre-seed stage, you get to the seed stage. And by that time, like I said, you got 20, 30 investors on the cap table. They all own a piece of the company. You start to realize pretty soon they all have different interests. Some going to be more interested than others. And ultimately, they all gave you $1. They want $15 back. If they could get $45 back, then they'll take 45. You only have one job. And so being really intentional on how you take cash, when you take cash, who you take cash from to build out the business is really important. And I guess the last thing is to realize at any stage it's really important to not have the mindset that no one going out to beg for money. And I think that's especially important as Africans. On the world stage, our governments beg for money everywhere they can. The perspective of Africa outside of business is our countries beg, we're poor. And so when it comes to business, obviously, it's the same thing, right? That's the perception. When we going out to fundraise, we ain't fundraising. This ain't grant money. You selling a piece of your business to build a business. And so it's really important to go with that mindset that I built something valuable. I selling a piece of it to someone in exchange for cash. I'm going to return that cash, but I ain't begging for no one money and I ain't fundraising. 99% of fundraising at the earliest stages is primarily a mindset. It's not really about, pitch decks and all that stuff. It's just about how you present yourself and how you position yourself. And 99% of the time, if not 100% of the time, people can take you more seriously when you're talking about the cap table. If I go into, I invest in companies, and if I go into a company meeting, a portfolio company, and during the call, they don't talk about the cap table once, then, that probably ain't that serious of a company at all. At the seed stage, we obviously have to speak about it, but at pre-seed, no one talking about it. So those 3 things: structure things like a cap table alongside the financial model. Don't just see how much money you can make. 2, realize early on that exits in Africa are not IPOs or M&As. They probably a profitable business that grows and scales and dominates a market. It's probably best to build that way. And then 3, the attitude we approach to fundraising can be begging. It's more about selling a piece of the business in order to build a bigger business.
This has gone from 0 to 100 in 2 seconds. This is very deep what you're sharing here today. I think, especially for me, because when we talk about exit, everybody is always happy because everybody wants to get acquired by either a Goldman Sachs, or you want to have conversations with a Binance. Everybody just wants to be able to sell their fintech to somebody who is big and just go rest. But it's interesting now from your perspective how, look, most times this doesn't even happen as a cash transaction. So you just have to take on, to exchange of shares and equity and all of that. And this is very exciting. Thank you so much. I think the question that would lead on from that would be, so the next question, so before we move on to the next question, guys, follow on liquidity. It's your first time on the show, right? Follow on liquidity across all socials, on your LinkedIn, on your Instagram, and follow on liquidity, guys. And also, A question and answer section is going to come in soon. So write down your questions, prepare them. You can start leaving your questions in the comment section now, and we'll take them up as soon as we can. All right. So, Mr. Marvin, as I was saying, so a question following up to everything we just talked about is this. So you've mentioned how companies are not, people need to be more attentive to how they structure their capital early on. So the question is, so how should equity be divided among co-founders, especially when there's especially when there's an unequal contribution of time, resources, or expertise? We see this as an issue every time in Africa. Please.
Yeah, for sure. For co-founders specifically, right?
Mm-hmm.
Yeah, whoever going to take on the most stress should be paid more equity. And so there's never actually like a true 50-50 split, and probably never recommended. Think of it this way. If Tinubu and his, friends had a 50-50% decision on what should happen in Nigeria, nothing would ever get done. And so it's kind of like similar, right? Like nothing would ever get done in a startup if it's 50-50 split. So that's already out the window. Whoever's going to take on the most stress should be paid more equity, right? And the most stress is typically the CEO of the business. And so, CTOs, CPOs, whoever, chief roles don't actually exist at an early stage of a company. Like they just really nice terms that we give ourselves. They're very senior roles, but we just give them to each other, right? But for this case, the person who is responsible for the CEO position is the person who's responsible for fundraising, who's responsible for sales primarily, who's responsible for the product, who's responsible for all the different things. When other people sleeping at night, the CEO is up trying to figure out how to unbury their business from dying. And so typically that ends up being the case. And that ain't a popular opinion, but it is my opinion. And the reason is that a startup takes, especially in our ecosystem, decades to build. Don't let anybody fool you. Like this ain't like a 5-year journey. This ain't like a 7-year journey. This ain't a 9-year. This ain't even a 10-year journey. This is a multiple decade journey, right? Not everybody has the resources, energy, or time or care to build things out for that long, right? And it's really important to be honest with that from the beginning. And so co-founder splits is a really like contentious thing, but it doesn't really need to be. I don't know why co-founders are such contentious relationships among people. It's just, a group of people decide to build a thing. That thing is going to take 15 years to build out. There's going to be a couple of the people who have to take on more stress than others, and that's okay. They might not have kids, or they might have more financial resources or not, et cetera, et cetera. And you just organize the equity that way. And it's hard to say what that looks like. There's 40-60, there's 70-30, there's 8-10, like there's 8-20, excuse me. There's so many different ways of doing it. But what's really important to do from the beginning, regardless of what everyone decides, is that whether it's the CEO, CPO, CTO, co-founders or not, the people who are actually going to build out the company is the consultants and employees of the business. And so more important than figuring out a co-founder split is figuring out like how we're going to structure the equity ownership of the business for the team. That's more important. And then 2, how are we going to structure the equity ownership for investors? When you add that in, you go from looking at 40-60 to looking immediately at, 40-10, because everyone's already been diluted. So going into a co-founding relationship and saying, all right, I own 60%, you own 40%, or vice versa, is misleading and kind of silly to talk about in that context, right? Because you're just diluting everyone, right? Like it's kind of like the C-level position at an early stage of a company. No one actually is C-level experienced. Right? Unless you're at a Series B company and you've done this for 30 years, you're not a C-level person. But we give ourselves those terms and it's okay. It's the same thing with equity. Saying we have 50-50 is not accurate because really, after investors and employees come in, we are already at, 30-30. So we might as well talk about it that way. And so that's how I'd advise probably thinking about co-founder stuff. Just realize everyone's been diluted already. That dilution means that we own less of the company, which is okay. That's how it's supposed to be, and probably more important. And then 2, whoever's going to actually be here for 15 years should be the person who is rewarded slightly more in equity, because ultimately they'll have to make the hard decisions when there's 30 other investors who have different interests trying to make different decisions on the cap table when other people have left. It's really important to be real about that. And, at pre-seed stage, everything is vibes, and you got your first 2, 3 customers on board, and things seem to be going well, but that ain't the hard stage of a company. The hard stage of a company is between seed and series A in our ecosystem. And many of us, ourselves included, get stuck there. And whoever can stick it out that is who's going to win or not. But before that, everything is vibes. The equity don't matter until past series B, but we think it does. And so I guess one is don't take it too seriously. 2, everyone diluted already. So it ain't about me having more control or not. It's more about us having control of the business. So if it was 50-50, but it's actually 30-30 because we've been diluted, it's more important as co-founders that we own 60% of the company than it is that you own 30 and I own 30.
Okay. This is very interesting. So we have to ask this one now, all right? So what should founders know about dilution and its impact on ownership during fundraising?
Yeah, for sure. We issue a lot of safes in our ecosystem as convertibles. And all that means is you are selling a future right to the business that is going to convert into shares at some point. But when you issue that safe, you've already diluted the company. So every time you issue a safe or common shares or whatever, the pie of ownership is changing, which means that the original people own less of the business. So if Michael, you and I start off a business and you own 70% of it, I own 30%. And then we issue 10% of the, stock options to, the employees, and then we issue another 15% to investors, then you and I go from owning 100% of the company to owning less than 75% of it. And so the percentage that we own of the business is lower, which means our voting power is automatically lower. But it doesn't necessarily mean that our value of our shares is going down. Typically, it means it's going up because we actually getting somewhere by doing these things. And so, dilution is pretty simple how it works. It's mostly a governance thing. And it depends a lot on how you structure things at the very beginning of the business.
All right, this is a very crucial topic because I think something I personally hold I have been taking more seriously very recently is corporate governance. Putting together that structure to ensure that everybody knows what they're about, everybody knows what we're doing here. Like, look, if you're holding on to 50%, it's 50%, maybe it's worth 10K now. But when investors come in or bring people in, valuation goes up, you get diluted, but you're whatever you hold is more valuable now than the 50%. I think it's interesting that people need to understand what dilution means. So there's a question from Johnson Igara. Johnson, I'd like you to, if you could structure your question better, but we'll get back to it. So try to be a little more clear with your question. And guys, if you have any more questions, please write them in the comment section. We're happy to answer them in shortly. So now we have to speak about employees and all the hard work they bring in because at some point from idea stage to MVP, most startups need to bring in people, need to put together a team, and it's also very essential. Most times this team can be paid with what they are worth in the market with money, at the moment. So we have to give them ownerships and shares and all of that. So the question is, how do employee stock option plans work, and what are the benefits and potential downsides?
Yeah, the employee stock option pool works this way. You create a pool. So I take 10 shares from the business and I put them in this pool. And that pool has its own set of rules for how it works. You could literally, everyone on the call could visualize an actual pool, like a real pool. And you take that pool and you put in a heater, you put in lanes, you paint it green or blue or red, and you put in sea salt water or just regular water or chlorine water. You could define exactly what you want that pool to look like. And based on how that pool is defined, you could decide who gets into that pool or not. So you have 10 shares in that pool, and that pool has been painted red and has 5 lanes. And then you got 30 employees at your business, and all 30 can get into the pool, or 25 of them can get into the pool. Some could get out in the pool into the pool at different times. Some could get into the pool, excuse me, on different days or different weeks or different months. Like it really depends on how the pool is built, and typically that's built on how well people can swim, which is what they do at a business. So someone might be a really good swimmer or a salesperson. Someone may be a really poor swimmer or who's a junior engineer, or not poor, like in not in the sense that they're bad at their job, but just less skilled because they're younger, so junior. And so the way they get into the pool and when they get in the pool is going to be different from someone who's like a senior engineer, for example, who's a really, really good swimmer. And so that pool is how stock option pools work. You take 10 shares, you put them in a pool. That's a legal process. Then people can participate by owning pieces of that pool, participating in it. And then when they leave the business, or if the business, exits or grows or is profitable and the company wants to buy back from that pool, then cash is exchanged to employees in exchange for those 10 shares that they had in the pool. That's how it typically works. Downsides is a bunch of different things, but typically none. Like I think it's really important that in our ecosystem, members of teams, employees, contractors own parts of the business. And so we have a stock option pool at Raise. We've helped a lot of companies set them up. Our stock option pools are very generous. It's how you attract talents. It's how you grow a business. And I think it's really important for all employees to recognize that even if you own parts of a pool of a business, it's more likely than not that that business is going to fail. And it's really important to realize that. But there's a small chance it'll succeed. And if it does, everyone's life will be changed. So might as well give it a shot.
All right. This is an interesting analogy. I don't think I've ever gotten an interesting expression of, stock options like this. Interesting. So
It's
whoever,
literally called an employee stock option pool.
Mhm.
Even in legal contracts, it's referred to as a pool. So, it's a difficult thing to grasp and conceptualize. So hopefully the pool analogy helps. But
Yeah, the pool makes it easy because if you're a junior swimmer, just stay by the shore, just stay by the bank.
yeah.
Just tap on the water, and let the big boys into the water. That's
Yeah,
cool. So,
that's
the
fine.
next question I have for you is, so this is very close to heart for every one of us in Africa. How is equity structuring in African startups different from other regions, and what unique challenges do African entrepreneurs face?
Yeah, the structuring ain't different. It shouldn't be different. You build in a business, you got employees, you got co-founders, you got investors. The only thing that's probably different is the way we should be financing our businesses. Not every company should be issuing safes, you know. Not every company should be being bootstrapped, They probably should be raising safes. So there's different kinds of financing instruments that we should be doing that, earlier versions of this ecosystem didn't do. We just kept it simple. And so I think that's that. The challenges are many. The typical seed stage African startup has like 4 different corporate structures in like 3 different countries. And so I can't think, I was actually speaking to a couple of friends and investors the other day about this. There's no other market in the world that has to deal with this. There's no other market in the world I can think of where a seed stage company, just to get to, $1 million, $2 million in revenue, has to structure and maintain like 4 different corporate structures and like 3 different licenses in multiple different countries. It's not common. Like India's one country, China's one country, America's one country with many states, but it's still one country. Latin America is several countries, but the big ones are like pretty unified in how they do things. Europe is one European Union, right? So it's a lot easier to do things. We all know that the African continent is extremely fragmented and structured, and our regulations differ even from, Lagos to another state, or from Nigeria to Ghana, and definitely from Ghana to Kenya. And so just to get to $2 million of revenue, you telling me I have to have a law firm in America? Cool. Then I got to have a law firm and a corporate structure in Nigeria. Then I have to have a law firm in Ghana because they don't understand the same law. And then I have to have another one in Kenya and South Africa. So I got 6 law firms, 6 corporate structures, 6 different fees and compliance to do every month. And all of that is meant to happen from an American company somewhere in Delaware that's never been to the African continent. And all of the equity that I have in that Delaware entity is meant to be issued to people that primarily live and operate and do business on the African continent. The amount of complexities and issues that that causes in equity ownership, equity exits, everything around structuring a company is probably too long to list. I think we figured out most of them as an ecosystem. Like more senior companies have the money and time to pay multiple law firms, but seed stage companies still don't. And so there's still quite a lot of complexities that have not been standardized, and the issues are many. One simple issue is if you are if you go in that pool and you get an equity from that pool as an employee from a Delaware-based American business, but you sit in Nigeria, you could imagine Nigerian government wants those taxes. Same thing for
Mhm.
Kenya, same thing for South Africa. And so that's one really simple complexity that exists. There's many, many other ones.
Oh, this is interesting. I think when we talk about regulation in Africa, it's a very painful experience for everyone. In as much as it seems like everyone in Africa who sort of like grew up in the environment is desensitized or finding their way around it, it's sort of like it stresses companies who are coming in and all. So I think next question I have, like a spin-off, would be: do you think there's been a progress in regards all these issues with structure, corporate governance, having to deal with different legal entities across? It's even sad when you mention the states because it's bad. Like in Nigeria, it can get as bad as that. If you're moving your product from Lagos to Port Harcourt and Abuja, you might just face a different challenge or issue
Hmm.
along the way, still in the same country. All right. So the question is, do you think we've made some progress in the past decade?
I hope so. I definitely think there's been a lot of progress made over the last couple of years, just because everyone had to figure out these things. So when you spoke to like a Delaware lawyer maybe 5 years ago about Nigerian law, they'd be like, "What?" You know. Whereas now, if you speak to them, they probably have done a couple deals and had to deal with a couple issues. Same thing for law firms on our side of the world. They, if you ask them about Delaware law a couple years ago, they were like, "Who?" Whereas now they've definitely interacted with some of that stuff. So I think we've just had to learn through trial and error. But definitely there's a market to standardize all this stuff and automate it and thing. That's why Raise exists, and is working. But there's still a lot of work to do just because, like I mentioned, just to get to a seed stage Series A, $1 to $2 million in annual revenue, we have customers that have in some extreme cases, up to 25 corporate structures under them. And some more typical cases, like 4 to 5 corporate structures, just to be able to get to $1 to $2 million in annual revenue. Most companies across the world just have to have one corporate structure and a very simple cap table to get to that amount of revenue. They don't have to do all this. Oh, they don't have to go through all this stress.
All the
Very,
gymnastics.
very simple.
Yeah.
Exactly.
That's very brilliant. Okay, so guys, prepare your questions. I can see a few questions in the comment section. After this last question, we'll be coming to the questions. So we have Marvin here. Ask him all the questions so your company, your shares, or your ownership or your equity doesn't get swept
Mhm.
off your feet. All right, so we have to ask
Exactly.
this one, Marvin. So, what final advice would you give to founders on structuring equity properly from the start to to ensure long-term success, and how can your company raise help them?
Sure. I'd say first thing is just check out our landing page and request access, and you'll get a really detailed summary of how we can help. And then the same applies we talked about earlier. If you structure an idea to exit, first thing you need to do is when you're modeling out how big this business can be on the market, make sure you also modeling out the cap table. which team you're going to need, how many people to build which products, to get into which markets, what's our corporate structure going to look like, and model out all of that stuff before you even start writing any code, just because it's a part of business building. Anybody can write code nowadays. So first is to just make sure you have the right business structure. Second thing is to be sure that the pieces that need to be built to accommodate that structure are really easy to do. So what does the cap table look like? Where's the corporate structures? What tools do I need to do that? You have like a legal stack, essentially. And then the third is probably to realize that exits in Africa are not the big, I got acquired for $200 million. I think a lot of people don't speak about this, but Paystack obviously is a great business. But I think we all discount how important market timing is. One of my mentors actually shared with me a really brilliant video recently that I'll drop, but it was that you could have the best team in the world, you could have the best product in the world, you could have the best advisors, and you could have hundreds of millions of dollars in your bank account. If your timing is off, your timing is off. Paystack timing was perfect. And I think that gave the illusion that that's going to happen across the ecosystem. It hasn't really happened since. And so exits are not that. Exits are profitable businesses that grow over time and hopefully get some kind of exit that matters. But a really strong exitable company in Africa, I believe, is going to be profitable, paying out, hundreds of thousands of dollars in dividends every quarter. Like that seems more realistic. Imagine, to whoever asked that question, instead of hoping that one day a business gets acquired by someone and you get a bunch of cash, right? May or may not happen, but it's not really happening. Instead of that, every quarter you can predict how much dollars are being paid out from this company to shareholders. That sounds like a really good alternative. So I'll resume it one last time. First thing is structure the cap table based on the financial model of a new business from idea to exit, realizing it's not the last time you're going to do that. And also make sure that just adjust expectations that the big exits on cash don't really happen here. It's more about being profitable and growing sustainably. That's a good exit.
All right, that's beautiful. It's interesting. Time and chance, I think it's something that we sort of like underrate. And what you just said is really deep. But then it makes sense. I think everybody always has their mind like they'll just hustle for 3, 4, 5 years, sell the company, and go live all their life on the beach or some
And I
island.
get it. And I get it. Like you, and I'm from an island, so I definitely fell into that trap. I'm from the Caribbean, and and I get it. We all tired. I tired. I wish that would happen, but the reality is that we all build in a continent we all appreciate and love, but that continent don't show the same love and appreciation back. This is the hardest place in the world to do business. Period. And so hoping that someone gonna come and save you is maybe not how we should be thinking about building businesses.
That's interesting. That's very, very insightful. So no one is coming to save us in Africa. We have to save ourselves, and just be in it for the long run. That's very good.
Yeah.
Thank you so much, Marvin. Very insightful session. So, guys, question and answer section now. I hope that you've been able to learn something. But Marvin, before we proceed to the question and answer, please tell some of the people who are watching how they can reach you. Reach you, the team. How can they get in touch with you and your team?
Sure, yeah. To everyone, y'all can get in touch with us anytime and get some of the support like we talked about right now. On our landing page at raise.africa, you can request access and someone will be in touch. Raise, like the verb, RAISE .africa.
All right, guys, you can see it on the screen. So it's raise.africa. All right. So,
Right.
yes, beautiful. Okay, so one of the questions we have here is from Martin Nani. So Martin asks, out of 2K plus startups that you have worked with, have you seen a firm be bought out without exchanging shares, as you previously mentioned? Have you been involved in a true cash buyout? What was the differentiator that caused that firm to be successful in their goal?
Sure, yeah. Mergers and acquisitions is primarily about timing and interests, right? And so, yeah, there's obviously been deals where there's a mix of cash and equity, and it happens. I guess when we think about exits, is more just like the value of the business, right? So, if you're making $100,000 a year, you're getting a 10x value on that. The business is worth 1 million, not 30 million, you know? So just because there's a valuation cap on safe does not mean that that is the valuation of the business. And that's a common misconception, at least I've seen quite a few times. Like the value of the business is your value to the company acquiring you, not the other way around. And so their acquisition needs is going to depend, to Martin's question, on the company, on the business, on their product stack. And it's going to be different in fintech or logistics or e-commerce, whatever it is. And primarily people buy in your distribution. Anybody can build products nowadays. They buy in your distribution and brand and reputation and stuff like that. And for that to be possible, there's many different ways to structure things. But we live in a currency inflated economy. Dollars are very expensive, and most companies earn in local currency, right? And so the mix of cash and equity happens. Pure cash, rare. Pure equity also happens quite commonly. And so, Martin, hopefully that gives you some context. And the businesses that are successful in doing the mix of cash and equity, again, it really depends on who they are, where they are, the interests that have aligned between those two different companies. It just varies. But what is not going to vary, more money you make in, the more you get acquired for. It really is that simple.
All right, this is interesting. Martin, I hope that we've been able to answer your question. Okay, so we have another question from Johnson Igara. So Johnson says, what steps can a business take when facing significant challenges or setbacks?
Thanks for that question. That also varies, and not sure how to answer it, but I guess it kind of goes back to Michael, the question you asked me about co-founders and co-founder splits. Business is going to have setbacks and challenges. Not everybody going to stick it through, and that's okay. And what businesses should go through depends on what they're going through, when they're going through it. Some businesses might need to be shut down. Some businesses might need to pivot and just go into maintenance mode. Some businesses raised at valuations that was too high, and their revenue that they're currently making is not high enough. Like it really depends on the use case, so it's hard to narrow it down. But if I'd recommend anything, is if your business is facing setbacks and challenges, I would highly recommend opening up a GPT, asking it for recommendations based on your specific situation. Ask it to be as critical as possible, and you'll get very helpful feedback. I'm serious. I've done this many times, and so have many, friends who have. Because anybody else you ask for the advice has an interest who is not interested.
Mhm.
GPT and other similar apps are impartial. They'll be honest with you.
No bias.
No bias. Yeah, they don't care, and that's a good thing.
All right, that's very good. So that's very insightful. So now you can ask ChatGPT, but I guess in the next couple of years you'll be able to chat with Elon's robot that you have bought and is in your house.
Exactly.
All right, that's good. Thank you so much, Gara. I hope that you answered your questions. Martin says, thank you very much. Appreciate it. Thank you so
Sure.
much, guys. We've come to the end of today's webinar. We hope that this was insightful for you. Thank you so much to the Get Raised team. Thank you so much, Marvin. So visit raise.africa. I think you can follow Marvin on LinkedIn. Marvin, what's your phone? I think it's Marvin. Marvin, what?
Colby.
Marvin.
Marvin Colby.
Okay.
Yeah.
Okay. So, guys, Kobe like this? Like this?
Coleby. Yeah,
Coleby. Okay. So, guys, you can
that's right.
follow
Yeah.
Leby. Okay. So you can follow Marvin on LinkedIn, right? Or you can follow you can visit Getray's website as well. Thank you so much, Marvin. I appreciate. I look forward to being able to contact your team when I'm building out my startup as well. Thank you so much for joining us today. Have a great day.
Appreciate it. Thanks for having
Bye.
us. We'll be
Yes.
ready. Bye-bye.
Bye. Yes.
All right, guys, thank you so much. We've come to the end of today's session. So follow One Liquidity if you haven't. Guys, show us some love on LinkedIn. Follow us on LinkedIn. We have exciting updates for you every now and then. Interesting content, webinars like this that are coming up, really exciting content, great material for everyone building in the startup ecosystem in Africa and across the globe. Visit our website if you have any questions about what we're doing at One Liquidity. If you are building anything and you need payments, you need support, you need business loans, we provide this kind of services. So visit One Liquidity, learn about what we're doing. If you have a question, reach out to us, send an email to us. We're excited to speak with you. Thank you so much, guys, for joining us today. Do have a great rest of your day and have a great weekend. Bye for now, guys.
One Liquidity isn't just talking innovation. We are walking the walk with impressive figures that showcase impact on Africa's financial landscape. Here are some key numbers that speak volumes. $5 billion+ in transaction, $10 million+ in monthly credits and loans, $500 million+ in B2B payments. These numbers translate to real progress. Businesses have access to the resources they need. Trade flourishes and Africa's economic engine gains momentum. One Liquidity impressive numbers are just the beginning. By choosing One Liquidity, you are not just partnering with a financial service provider, you are joining a movement driving positive change across Africa. Sign up for a demo account today. One Liquidity isn't just talking innovation.